You know, when I was a financial journalist, I had the unparalleled opportunity to talk with financiers and traders on Wall Street. And one thing that stands out from those times, calling around on the street to find out what was happening, is that the best of my contacts, they knew how to envision a potential investment trend coming together from what appears, to us ordinary mortals as a series of separate events. They can sort of fill in all the blanks and figure out where the market's going next. And I think that's what's going to happen with emerging markets in the next coming handful of months. We have a parade of events about to happen, put them all together, and I think we have a great rally in hand on top of the great performance we've already seen from the sector over the past number of months. As I noted late last year, emerging markets as a group have been getting stronger. They've been outperforming the U.S. market indexes. The S&P 500 bottomed the day after Christmas. That index is up around 7 or 8%, while a proxy like the iShares MSCI Emerging Markets Index is up 12%. And likewise, if you look at this longer term chart here since mid-October, the S&P is down about 6%, while the Emerging Markets ETF is in positive territory, up more than 3%. So the first of the sort of parade of events I see happening here is the resolution of the EU's Brexit problem. Here's the thing, markets hate uncertainty, and for the last 2 years, Brexit has been the biggest uncertainty hanging over Europe. I think that also rubs off for U.S. investors who are reluctant to invest outside the United States, and Europe being the biggest of those, even though it's not really an emerging market. The second is the U.S.-China trade standoff. The U.S. Trade Representative Robert Lighthizer and his Chinese counterpart, they're meeting at the end of this week for sort of high-level trade talks. But a lesser-known aspect of this is that China's central bank, as a result of this trade impasse and the slowing of the Chinese economy, has been pushing a lot of economic stimulus into the Chinese banking system. That liquidity ultimately finds its way into Chinese equities, and China is the biggest emerging market of them all. Whatever helps China helps all emerging market sectors as a group. The third thing is the Federal Reserve's increasingly dovish stance on interest rates. When the Fed raises rates, that makes the dollar stronger, and that hurts emerging market currencies and hurts the companies and the stocks that are located within those countries that are outside the United States. When the Fed does the opposite, when it either eases off on interest rates, cuts them, or just decides not to raise them, that helps emerging market currencies and therefore helps their stocks as well. The final note I want to make here is that the S&P 500 is either fully valued or overvalued, depending on who you want to talk to, as where so many emerging market indexes are undervalued and undervalued to historical extremes. So when you think about that, you think about the U.S. at its sort of the height of its, at peak economic strength, if you will. And we have a U.S. stock market also at peak valuations, broadly speaking. Then you look at what emerging market sectors are doing or haven't been doing over the last 3, 4, or 5 years. And I think you're going to see emerging markets come in for a lot more buying from global investors. And that's going to push all of these indexes much higher versus the S&P 500. Emerging markets are the place to go for 2019, and I think for the next handful of years. If you like what I'm talking about here, remember to click on the screen for more information. I'm Jeff Yastine.